Well, I just want to introduce you to everyone that is watching today. So this is Shannon Lee Simmons, and she is a personal finance expert, a financial planner. You're the founder of the New School of Finance. You're sort of a go-to person when we want to talk about anything financial, and especially for young Canadians.
Absolutely.
One of your top topics. So when you're thinking about some of the challenges that young Canadians are facing right now, what is sort of the first thing that comes to mind for you?
Well, right now, even timeliness, like at the very beginning of the year, I think most people are really stoked to like do something with their finances this year.
Yes.
We're just coming off of the holiday hangover and it's like, oh. And so what the biggest question I get right now is almost like everyone's excited, but they don't know how to take action. They don't know what that first step is, but they want to do something to improve. And some people want to buy a house. Some people have totally given up on that. Like there's lots of different goals, but I think the commonality between young Canadians is that they're like, this is my year.
So do you start with the small goals or the like buy a house goal?
It totally depends. So it depends on the person. So I have like one couple that comes in and they're like, we want to buy a house and that is the only thing we want to do. And I'm like, cool. So like, as long as you don't have massive amounts of credit card debt that are just staring me in the face that I can't ignore. And if you know you've got job security or you've got an emergency fund, then like let's focus on that. But some people come in and they're like, I don't know what my goals are. And that's a completely different conversation because it's like sometimes even if you don't know what your goals are, that's a goal in itself. I want to save, but I just want to keep it flexible and open because I'm not sure what my life looks like.
Right.
That's a goal in itself.
So I have lots of questions for Shannon, but I hope you do too. Whoever's watching out there, send in your questions in the comments on this Facebook Live that we're doing today. So send us your questions and we'll get Shannon to answer them for us because she is a wealth of information. But I mean, I have tons of questions too. So one of the things that I found difficult coming out of university, you have a great big student loan to deal with.
I remember mine.
Right? I mean, it tends to be the case. Yeah. So what do you do? How do you prioritize? What do you do first?
The first thing is if you get a job. And I think that that's like the hardest thing, right? Is that like all of this stuff is waiting on this one crucial, critical thing to happen. So I think finding ways to make money is really important, whether you get the job or not. Maybe you can do like a side hustle or you can start something, even if it's like Uber or something to get some cash flow in, because you can't do anything unless we have money coming in the door. So really focusing on that. And also if you're lucky enough to be able to live at home for a small period of time, I hate giving that as advice because not everyone's able to do that, but it does help if you don't have to have a massive rent, like if you can't afford rent every month, because paying down debt and paying rent at the same time when you're first starting out on that beginner salary is a tall order. So I think that trying to get the biggest bang for your buck that way with your expenses and trying to get some money in the door. And then I think we just look at the debt and just take a deep breath and say, this might take some time. I know people have done extreme things. I did an extreme thing. I lived at home for a year and I paid off like $20,000.
Oh my goodness.
But I lived off of $40 a week. I was living at home though, so I didn't have any other expenses. $40 was like for fun, right?
Right. Yeah, that's a pretty special situation.
Completely.
Yeah.
So,
I do have a question that's come in. So Wendy O'Keefe, they're asking, what is the best way for my 20-year-old to save money for a home? As in, how much a month and where to place it? Which is a great question.
Great question. Yeah. Okay, so there's a few factors there to talk about. So the first thing that I would make sure is like, what are we saving towards? So take whatever the value of the dream house, I mean, besides $1 million. And you know, you want to aim for that 20% mark. Not a lot of people can hit that. So my advice is always like 10%. Okay. So that's kind of like where we want to be. So if it's a $500,000 place, we're aiming for like $100,000 down. Then work backwards, like divide that out by how long you want until that person is like, maybe they want to buy it at 28 and they're 20, how old were they? Like
20-year-old,
So let's say divide that by 8 years. Now you have your amount that you need to save. And the best thing to do is a combination of RRSP and tax-free savings account.
Okay, a combo.
Yeah, so RRSP, the first-time homebuyers plan, is amazing. So if they qualify as a first-time homebuyer, they can take out up to $25,000 like tax-free and then pay it back over 15 years.
Right.
But anything above that 25 can't be used for your down payment without paying tax. So a heartbreaking thing that I see sometimes is someone's shoved all their money into the RRSP. They've got like $40,000 in there, but 15 of that is not part of that home buyer's plan.
Yeah.
So that's something to watch out. And then I would put the rest in the tax-free savings account if they've got the room. That's a huge thing for a young person, is just to make sure that they have the room. And because at least then it's tax sheltered. And so those would be the best places.
And you like that 10%.
I love that 10%.
Yeah.
And mortgage rules just changed recently as well, and it's just making it more and more difficult. Depending on, sometimes you have to put down 10%. It's not even an option, right?
Right.
So 10% should be the minimum, and it's like, I mean, if you're in the $1 million plus market, you might have to put down even more.
Right. But if you're in that market, maybe you have more to put down.
Yeah, right. So maybe you won the lottery or had a rich uncle. So
exactly. Okay, we've got another question. So Kenny Andrews asks, what advice can you give someone who has financial issues but has goals of buying a house and or a car in the near future? So maybe those would be issues with credit, I suppose?
Yeah, it could be, or cash flow issues or something like that. So if it's, let's start with credit issues. I think that's a great point.
Yeah.
So if you've got credit issues, why that's important to fix up on your credit report is that you'll get a better rate on your mortgage. You'll qualify for maybe more of a mortgage. If you have the less debt you have, the more that they'll lend you, right? So getting that total debt service ratio down is really important. So if you do have, the best way to impact your credit is to actually just make your minimum payments on time, but also the usage ratio. And I'm not sure if that's the technical term, but like, let's say that your credit card, you can borrow 10,000.
Yes.
If you use utilization rate, that's the
right.
word.
Yeah.
If you always have it maxed out, that really hurts your credit. Whereas if you have it like under 3,000, even if you carry a balance, that's actually, it's not as bad. So trying to pay down those debts and get them under, like get your utilization rate, nothing that's maxed out, is a really great way to improve your credit. And hopefully you can get your, like everyone should do a credit report. Like like you can go and you can get them for free now at like Borrow Well and stuff. And you're aiming to have like 720 and above that you would be ACEs. So I think that that's the first thing that you want to do if you're having issues. And the other thing, if you want to do all of the things, if cash flow isn't an issue, then you kind of have to just prioritize what's most important, right? I mean, you're not just going to wake up tomorrow and have all of the money to do all of the things. So I think that what you want to do is get your credit under control and then prioritize, okay, if it's car and house, which one's the most important to me and what do I have to do first? And then we can sway which one that would go to.
It's so difficult, though.
It's
only
almost
get
impossible.
So much money a month, or every 2 weeks, or however you're paid. And deciding where it goes is really tough. I have more questions coming in. So Katrina Moe says, any tips to get out of about $25,000 in credit card debt? Will a consolidation loan destroy my credit, or should I keep aggressively paying my card with 19.99% interest? It's not budging very quickly. Yeah. So Katrina's in a bit of a tough spot.
That's totally normal. Yeah. I hear this all the time. So you're not alone. I think that's important.
Yeah.
Okay. So first things first. You might have already done this, but call your bank and see if you can get them to lower the rate. That is like the first thing that you want to do.
You can just call your bank.
You can call it. Doesn't mean that they're going to say yes.
Right.
But if you have a relatively good, like let's say that she's been making her minimum payments on time and like her credit rating is actually not so bad.
Yeah.
They may be willing to work with you sometimes, right? So if you've been a customer for a long time and you might be able to negotiate.
It's worth a shot.
Yeah, remember that you're a customer of the bank. They're not a government agency. You're a customer and they want to hold on to your business. They're making a lot of money off of you. So try to negotiate that. The second thing would be to apply with a financial institution for a consolidation loan, which is not a consumer proposal. So a consolidation loan is when you a bank buys your credit card debt and then they roll it into, so you don't get a discount on it or anything. If you have $25,000, it's $25,000, but they'll amortize it over a certain period on a structured repayment plan at a lower rate. The problem with consolidation loans is that you have to qualify. So you can sit down with the bank and ask them, and they'll run some numbers, and they might be like, no, so they won't even go through the whole application process unless they know that they can do that.
Yeah.
And then the last lines of defense is to get in touch with a bankruptcy trustee. If you want to talk about consumer proposals, not even bankruptcy, you don't even have to go there. I know everyone is scared of that word, but a consumer proposal or a bankruptcy would be done under the advice of somebody who is a bankruptcy trustee. So I would talk to somebody about that first before you made any moves on a consumer proposal. They can be great and life-saving for some people, but they do affect your credit for a very long period of time.
Okay.
And it's not easy to go through one. So I don't think there's no shame in it. They're a tool in the toolkit for a reason, but you want to get some really good advice about what the consequences of that on your financial life are before you go down that road.
Sure. Okay. This is great, Shannon. This is Shannon Lee Simmons that's with us today, a personal finance expert, as you can tell. And we are taking your questions, so please send them in. We're, know, we're talking a lot about young Canadians' financial issues lately, how hard it is to get into the housing market, how hard it is to find that nice, stable, secure job, and retirement. You know, that's one of those other things that we're thinking about, but talking about today. So we're taking your questions. So next up, we have Richard Doolin and Jacqueline. Is there a website where Jacqueline is me? I'm Jacqueline Hansen, the reporter. Is there a website where further information can be provided? So you have a blog, which would be one great place to look at.
With a lot of free stuff on it.
So that's the New School of Finance.
Yeah, newschoolfinance.com, and then it's a free stuff tab, and it's like a plethora of information.
And then do you have any go-to places that you look for stuff?
Yeah, so I mean, there's tons of stuff on the internet that's free, which is awesome. I love the Gen Y Money hashtag, which the Globe and Mail does, and that's like a plethora of different authors all over the place that will write things that are specifically for, you know, younger Canadians, and I think that that's a really good resource as well.
Okay.
So anything like that, but like find a trusted resource. Like sometimes the internet is too much knowledge, and I actually think that sometimes can lend to the stress that we feel these days. It's like, oh my gosh, it's not a lack of knowledge, it's an overload, right? It's like, who do you trust? What information is relevant to you? And sometimes going to the internet is like, you know, kind of like self-diagnosing on WebMD. Right?
Totally.
Like, is this me, or do I, you know, is it a headache or not?
Well, it's sort of like that New Year's resolution thing you said, right? Like, I'm going to get my finances in order this year.
Now what?
And now what? Yeah. Okay, so let's go to Francois Messier. What is the best place to find a financial advisor like yourself? You're a financial planner.
Yeah.
I don't feel like the people in the banks are on the client side. So what's your advice there?
Absolutely. So you want to, for me, anyone that calls himself a financial planner, you should be registered with the Financial Planning Standards Council, which means that they are a certified financial planner. So I would start there.
And how would you know that person?
There's a directory.
Okay.
So all you have to do is if you go to the Financial Planning Standards Council, which is fpsc.ca, I think.
Okay.
But just Google it.
Yeah.
If you go to their website, you can search an advisor or a planner. Advisor and planner get used interchangeably sometimes.
Okay.
So one doesn't necessarily, like if you're an advisor, that doesn't mean that you're not a planner, so to speak. And so you can search that person's name and just make sure that they're registered. Also, sometimes what you can do on their website is go in and click what you're looking for, where your location is, and everybody who's registered in that vicinity that specializes in what you're looking for will come up. So I would start there. And then the second thing that I would also do is like talk to people in your community, your friends and your peers that are in the same financial situation as you. You know, go into your neighbor who has a $3 million house and has been mortgage free for 5 years. Don't go to their person, because their person probably doesn't get you and your personal situation.
Well, I'm curious about. So a young person who perhaps doesn't have that much money to invest in the first place, do they need a financial advisor? Like, is this something that I could figure out on my own? Or, you know, at what point do you think you need to get some professional assistance?
I have two opinions on this.
Yeah.
So, like, this is obviously biased because I'm a family financial planner and I'm biased. So, like, I'm biased right now.
It's okay.
So I'm not even trying to shamelessly promote myself. I'm trying to promote the idea of like sitting down with a professional and mapping out a plan.
Yeah.
So I think that a lot of times what the problem is in the financial industry is that there are these investment minimums. So if you have debt and nothing in your savings account, no one will talk to you.
Yeah.
So that's frustrating. Or you might get sold something that's a really expensive product and like oversold insurance or something like that. Not saying that every advisor is like that. But if you can find somebody who is an unbiased party who's like affordable, wink, no, I'm just kidding. I'm just kidding. And so that's kind of like I think that there's you want to sit down with somebody because there is so much information out there. You can totally do it yourself, but how do you know what the best bang for your buck is? And a lot of times what happens too is that we try something on, like, I'm going to equate it to health. You Google, I'm going to like do whatever for my wellness and health this year, and you Google a plan and you try it out, and it doesn't work for you, and you feel like crap about it, and maybe you feel like you're not a healthy person. Well, with money, the same thing happens. If you get on a plan that, like the RRSP thing, for example, the internet will tell you to throw your money to RRSP. Well, then what if you did want to buy a house and you put in more than 25? Like, that's something that could have been caught. So, and then more strategically placed, right?
Yeah.
So there's those kinds of things, but also just like being okay with like failing with your finances and then like getting back on the horse and riding it, and like working with somebody can actually help you like hone that in and be like, oh, that didn't work for you. Let's try this now. Let's try this, right?
Kind of like you know.
It's like a personal trainer.
I was just going to say, kind of like a personal trainer.
Nope, it's the best metaphor. Like, it's
You've
fine.
gotten so far on your own, but you just need a little bit of help to, you know, freshen things up or see it from a different perspective.
But at the same time, DIYing it, I am also
there's
a fan
a ton of other
saving
options.
your money and doing it that way. So just make sure that you're well researched and you trust your resource.
Okay, so let's move on to, let's see here. Penny Duke asks, let's see here. How will the Ontario government view previous school debt after tuition becomes free? How to find out? I'm not sure about that one.
I'm not entirely sure because the policy is changing.
Yeah.
So I would actually just say you should go to the OSAP website or you should go to like the Ontario government website and check it out there. There was always this like, I don't even know if it was a myth because some people have said it's happened to them, like OSAP forgiveness.
Right.
Oh my gosh. Right? Like very exciting times. If you haven't been able to pay it for like 10 years or something, parts of it is forgiven. But the new rules I'm not entirely sure of, so I don't want to speak out of turn.
That's totally fine. So let's go to Andrew Q. Says, no debt. I have an emergency fund. I've maxed out my TFSA and RRSP.
What up?
Nicely done.
Nice.
Not interested in buying a home. What do I do with my money now?
Excellent.
Cool.
Okay, so
All right.
make sure that you're renting affordably, and I think that's like the first thing. I love renting. I think renting is the best, especially in a city where houses are like $1.5 million and they're
so
crumbling.
Interesting. So you are on the rent side. Okay, cool.
I'm pro buying, and I'm also pro renting. I'm pro buying if you can afford it.
Right.
But mostly, who can afford an $850,000 mortgage? I ask you, who? Even with mega incomes, that's still that's a tough road, right?
Yeah.
If interest rates go up by 2% and all, everyone's so. No. So I'm a fan of buying if you can afford it, and if you can't afford to buy, that's cool too. I'm a big fan of renting for life, or at least even until maybe things change. Who knows, 5-10 years from now.
But the thing is, and sorry, we'll jump back. Yeah,
that's an important question.
I see, so many of my friends' parents, they're all relying on their homes in their retirement.
Yes.
So they're sort of setting this example for us, and then I think that's part of the reason why it's drilled into our heads that we need to buy a home.
Yeah, completely. So baby boomers, which are most millennial parents, have made a killing. Typically speaking, in like major urban centers,
in the major centers,
have made a killing on it. They also had stable employment, maybe pensions, and a whole different. They were dealt a completely different hand than us. So for us to compare our hand to theirs is like doesn't make sense. Like cannot compute. But that is. So what's also happening, and what I've noticed, especially since like 2008. A bunch of millennials came out, they heard about the crash, they didn't get jobs.
Yeah.
So like stock market unemployment, bad, housing good. Interest rates were super cheap, housing prices soared. So all of that bombardment, today they just announced that like the housing market in Toronto grew by 20%.
Yeah.
So when you hear that stuff in the media, you automatically think, I'm bad with money if I don't have a house. I'm an idiot. I'm missing out. I'm never going to be okay. If I don't do that, my finances are screwed. And so
such a negative weight.
But it's impossible not to because that's what we're bombarded with. Keep in mind that like what's happening is unprecedented. Housing markets have crashed in the past. Interest rates have gone up like in the 80s, I think there was mortgages like 14%.
No, in the 80s, it was above 20% for like
wild.
a 5-year fixed rate.
Can you imagine? And we were worried about a 19% credit card. Like, that's a problem, right? So things do happen.
Yeah.
And like the housing market in the U.S. crashed in 2008. Everyone thought it would never go anywhere, right?
Yeah.
So back to your question.
So back to where does the money go? If you're not going to buy a house, what are you going to do with it so that, years from now, decades from now,
you're okay.
You're okay.
I'm talking like Lorelai Gilmore, like so fast. Like as fast as I can. Okay, so what you want to do is make sure that you're renting affordably. So you need to take advantage of the fact that you are not paying for repair, maintenance, a furnace. Oh my God, there's termites. Like, woohoo.
Yeah.
So rent affordably and make sure that you're saving 20% of your after-tax income for the long term. That's my tip for anyone who's deciding to like rent for life, because you're not going to. What is lovely about owning a home is that even if your housing price, let's say you bought it at $500 and it never appreciated, your mortgage payments, part of that is forced savings, right?
Yes, exactly.
So as long as your housing price doesn't crumble to zero, which is that I feel like is more unlikely, but who knows? You are building that savings, so at least you're sitting on something. And here's what I tell my clients too: in retirement, one day you're mortgage free. Let's say that the housing market crashes and your $500,000 house becomes $10,000. But if you're mortgage free, who cares? You have a place to live that you don't have to pay for except for bills and maintenance and stuff.
Yeah.
That is a bonus that you cannot replace with renting.
Right.
Period. Full stop. So there's that.
So you kind of need to save enough to
for
make
rainy
up for
day,
that.
for rainy days,
Yeah.
and also the renter's dilemma is that one day you could get kicked out of your really affordable place, and then you're subject to market rent. And that just happened to clients of mine, friends of mine, especially in this Toronto market with the rental.
Yeah, it's so competitive.
So just make sure that you're saving more than what a person who has home equity is saving for retirement. So that 20% of your after-tax income is a way to like get that done.
Yeah.
You just got to oversave and make up for the fact that you don't have all those extra bills.
Okay, so just to check in again, so this is Shannon Lee Simmons. She's with the New School of Finance. She's also a personal finance expert and just helping us out with a ton of questions, which is fantastic. Keep sending them in. We're talking about young Canadians and the financial issues that you're facing this year, well, every year. So let's go on to the next one here, and we have, let's say, Donald King says, the kids today are being offered $12 an hour to do the exact same job that paid me $17 30 years ago, while the cost of living has tripled. So he's just curious for your reaction to that.
Okay, so it's a huge difference, and it's why we all feel really scared about our financial future.
Yeah.
That's the economic hand that we were dealt. So here's the only thing that we can do. I say this a lot. The only way to like move forward with your finances is either to like bring in more money or spend less money. So as a generation, I think our expectations of what we're going to achieve need to change. Because when you have, if you're in a situation where a job is no longer paying what it did, there is no magic solution.
Yeah.
Do you know what I mean? And that's why we're seeing so much debt, because what I'm also guilty of this too. Like, well, I thought that this would be what I could do when I was 30. So what do you mean I can't do that when I'm 30 years old, right? So our expectations need to like adjust if our incomes aren't gonna do what they need them to do, and that's a buzzkill.
Yeah.
For sure, nobody wants. It's like, ugh, nobody wants to hear that. But if you're only making so much, there's not much else that you can do unless you spiral into debt. And I think that spiraling into debt actually causes more anxiety, but it's hidden anxiety.
Right.
It's like 3 a.m. anxiety than like saying no to stuff that like maybe we want to do, like maybe we go on less trips, maybe we adjust our housing expectations.
Expectations, yeah. Okay, so let's move on. We've been flying through the time already, so let's try to get a couple more of these in. So Stan Liu says, I'm 30. How much in today's dollars do I need to have if I want to retire at 50 with a $25,000 annual pension? Assume I live to 75. Okay, that sounds...
That's a lot. I'm not a human calculator, but what I would suggest is like, you are a perfect candidate for someone who is ready to sit down and map out a financial plan, because you know what you want, and you can work backwards from that. So I would say like you should get some advice, because that's a loaded question.
Yeah.
There are so many other variables that have to pay into that, and the old adage of like have $1 million is not necessarily adequate for you, or maybe more than enough depending on your situation.
Yeah. Okay, cool. So Ed good for you guys talking about this. Cool. Thanks for watching. He says, I worked for 10 years at just above minimum wages, spending little or no money on frivolous things like eating out, TV, having the latest tech, toys, fashions, etc. Bought my house at 27 years old with 20% down when I only needed 10. I believe in saving, but spending wisely is even more important. So just sort of commenting on that. And I think, I think the younger generation kind of, we get a bit of negative feedback sometimes, saying that we have all of these tech toys and we're entitled and all of these things. No. But it is a good reminder to think about what you're spending your money on, and and doing that wisely, right?
So here's what I would say to that. First of all, also when I said expectations changing, I did not mean to say that we are entitled. What I meant to say was just like, because I feel that pain hard, right? Like, I just mean like, if there's only $3, you only have $3, so spend it wisely. So here's what I would say about whether it's lattes or tech toys, and this is what we get painted
of course,
with
the lattes and the iPhones.
All the time, and like over travel. Okay, so who cares where you spend your money?
Okay.
I don't care where you spend your money, I don't care where you spend your money, I don't care where I spend money, as long as it's kind of within this band of affordability. So if you've got $1,000 a month to blow to zero every month, why do we care if it goes to groceries or going out for dinner or buying lunch out? As long as it's within what you can afford, like, who cares?
Right. Okay.
And so I think that that's what, so I would say spending mindfully for me and like living within your means and all that jargon is actually just about like within the spending money that you've got, making sure that you are spending money on what is important to you and nobody else, and not feeling judged by that, because then you feel like you get a big bang for your buck. Like, so I'll give you an example. Every morning I buy an expensive $4 latte. Every single morning.
And you're good with that?
I'm so okay with that because I enjoy the whole process of it. So I'm willing to give up things that don't make me as happy so that I have that. So when I read like latte shaming, I'm like, no, I'm still living within my means and still buying a $4 coffee. And everybody's like, but do you know how much you could save if you gave that up? Like, yes, I've run the numbers, but I don't care.
Like, you really do know. Okay.
I don't care.
Let's grab something else from here. So Joey says, oh, this is nice. Joey says that this planning should be taught in high school. That's cool. I totally agree. I don't think I had this conversation in high school.
It's starting.
I feel really lucky being here because we have all of these really smart people coming through and I get to ask questions of them, but this is a great opportunity to get to do that, and hopefully we can do some more in the future. But Bassam says there is something weird going on these days with this economy we have. Most employers, when they hire, they run a credit check. Oh, interesting. Being in a bad financial situation should not judge my personality. Have you come across that?
Yeah, so I had to do a credit check when I applied for my job on Bay Street as well, but back then, a lot of times it's like identity theft and like federal identification. It's more like, are you who you say you are?
Okay.
I could be speaking out of turn. I don't know what that employer's like hidden agenda was.
Sure.
But it shouldn't affect your employability. Typically, and I'm saying all these broad sweeping generalizations, typically the point is just to like confirm your identification, like you are who you are and all that kind of stuff, like federal ID. Not every employer does that, obviously. It typically is financial institutions that would. I wouldn't be surprised if it was a financial institution.
So I mean, when we were talking about all of this, it all sounds so personal to me. So when we're talking about, if you're in your 30s or in your 20s, in your 30s, your priorities are going to be different than, your colleagues, your friends, that kind of thing. So when you're thinking about like what a 25-year-old, that sort of mid-20s should be thinking about in terms of their finances, how do they know that they're on track? Like what's one good
indicator?
Indicator.
You're not going into credit card debt every month.
Okay.
If you are holding steady, even if you have debt. Yeah. So let's say you've racked up 3 Gs because you like moved or something.
Yeah.
If it's staying at $3,000 and you're able to make your minimum payments, that just means that it doesn't mean you're on track. It just means that you're breaking even. Yeah. If you're not actively going into debt every month, that is a good sign that there is levers that you can pull. Okay. Right? Otherwise, if you're sinking, the work is that much more because you're going to have to cut.
Okay, this has been fantastic having you here, Shannon, and thank you all for tuning in and sharing your questions with us. And if you have any others, just leave them in the comments and we will try to answer them. You can check out Shannon on Twitter or myself and we'll try to get back to you. So thank you so much for joining us.
Thanks for having me.
Yeah, thank you.